We're now getting to the tail end of the presentation. You'll remember we've gone through the various grant options, we've gone through the family funding options, and the final option that I indicated that we'd be talking about today was angel investment. It's really a funny name, an angel. What they are is people who've been successful business people in their own right. They may have some investments in property, in cash, in bonds, in listed equities. And having already got those, they may apply some of their liquid assets, cash, to more risky assets. They're called angel investors. And it is very risky investments, but the returns potentially are very high. A few years ago, you wouldn't have found any formal groups where these types of investors populated or congregated. But today, it's really quite a well-established and sophisticated ecosystem in Australia. As I understand it, today there are around 13 formal angel groups around the country, including here in the ACT. The group in the ACT is called Capital Angels. They've been going since 2005, and they have helped numerous entrepreneurs on their journey towards commercial success. The process for an angel investment is as follows. An entrepreneur will apply to the group. The group typically will have somebody who takes that opportunity and meets with the entrepreneur to understand what the opportunity is. They see their presentation, they may review and evaluate their product. And if they are comfortable with that, then they would submit it to the screening committee. What the screening committee does is they consider all of the opportunities that are coming through that particular cohort at that particular time, and they make a determination on which of those entrepreneurs should go forward to present to the broader group. Capital Angels runs 4 meetings a year, usually in the autumn, the winter and the spring. We typically don't have events during the summer. And you present in front of people who have the capacity to invest in your business. If you're applying for angel investment, typically you can apply for anything from as low as $50,000 all the way up to $100,000, maybe even as high as $1 million. Here in the ACT, the typical range is $50,000 to around $350,000, and you are offering up equity shares in your business. They are buying shares in your company. The process after you've presented to these individuals is typically 1, 2, 3, maybe more of them will group together in a syndicate, and that syndicate will negotiate with you what the terms of the investment are, what the pre-money valuation is, so what's the value of your business before the money is invested, and once the money's gone in, what is the value of your business after the money has gone in. Usually they don't give you all the money up front. Usually they'll set milestones, and this is called tranching. So you may have 2 tranches where they give you 50% of the money up front, and then they set you some milestones to achieve over the next 6, 9 or 12 months. And if you achieve all of those milestones, at the end of that time, they'll give you the second tranche. It's very common for angel investments to be tranched. The other thing is that you should not just look at this as money. It's more than that. In fact, it's domain expertise, so it's people who may have been in your industry all of their working career, but they've sold their business, they've retired, they don't want to do the heavy lifting anymore, but what they may want to do is go on that journey with you again. They may see you as themselves 20 or 25 years ago, a young entrepreneur trying to make it big and believing in themselves and their ideas. So what they'll give you is not just money, but domain expertise, and the final thing they should offer you is their networks. So these individuals usually have fabulous networks. They can open doors that you could never open. And so when you're looking at angel investment, only look at the cash as the third element, because Money that doesn't have the domain experts or the networks really isn't as valuable to you as the money that comes from people with great networks, great domain expertise, and the money. So you need to find people who have those three things before you take that money on board. You need to make sure you're prepared. Typical investors see many submissions. Some investors may look at as many as 300 opportunities every year and may only invest in one or two. So the attrition rate is very high. You need to be prepared with your pitch, a 90-second pitch, whether you're meeting them on the plane, whether you're meeting them at the group. You've got to have a very short pitch that describes the problem that you're trying to solve, that identifies the target market, that explains what the opportunity is, and explains why you and your team are the right people to make a success of it. They will make very quick judgments. If you can't explain what your business problem is and what the solution is that you're offering in 90 seconds, they'll pass and move on to the next one. So you must practice your elevator pitch, as it is called. You need to have a simple summary of what your business idea and opportunity is. That is typically called an executive summary. That shouldn't require a non-disclosure agreement. It shouldn't have any confidential information in it, but a very strong summary as to what the opportunity is and what you're looking for. You need to let them know what how much money you're raising and what you're going to use that money for. Behind the scenes, you do need to have an information memorandum. That's what IM means on the screen, information memorandum, and a business plan. You should never give those out without a non-disclosure agreement. That's much further in terms of your relationship with the investor. You really need to know them and validate them very thoroughly before you provide that sort of confidential information to them. You need to know what you're going to do with the money. So if you're raising $100,000, why is it $100,000? What are you going to use that $100,000 for? Is $30,000 going to go to the developer? Is $30,000 going to go to marketing? Is the balance $40,000 going to go to fund you and your marketing expenditure? You need to know, you need to be able to communicate that very clearly. The final thing that you must have is you need to make sure that you own the intellectual property. So frequently, if it is ill-defined or it's unclear who owns the intellectual property, the investor will walk away. They need to guarantee that you own the IP and that there are no questionable ownership issues. And the final thing to remember is that these investors are in it for a financial return. They're not doing it necessarily for the public good. They're doing it to make money. You need to explain to the investor how they're going to make money, who you're potentially going to sell this business to, when, and for potentially how much. Clearly that will change over time, but you have to have thought about that. And that's called the exit strategy. So you need to have thought about who in the market is likely to want to buy this in future years.
Nick, question?
Yes.
You talked a lot about the investors almost becoming part of your team, providing you with expertise and networks and that type of thing. How important is a team? So when you actually go and do your pitch, how important is it for you to display the people who are actually part of your team into making this business a reality?
It's a very good question. I'm a great believer that a single entrepreneur has less chance of success than a team. My view is based on the investments that I've made over the years, and I've categorized the winners with the ones that didn't win. And the ones that won, they had a particular profile. They had a sales god who was the front person, who could sell the vision, who really understood what the opportunity was. They were a great communicator, they were a great motivator, they were good at getting investment dollars. I call them the sales god. And then, because I purely invest in software companies, I needed the tech god. They're the person who is great at building things, they have fabulous IT skills, They've got great experience in building software products very, very fast, but really well. And in my view, you need that team, I call them the dream team, the sales god and the tech god, to be successful. But bear in mind, that's just in my area of investment. So I think the question is, you need to have a team of people around you that bring divergent skills to the table. An investor is unlikely to believe that you have all of those capabilities within one individual. So you need to find people that complement you not just in terms of skills, but in personality as well. I need to see a very harmonious team. There's nothing worse than having a team with very strong personalities that destroys itself. So I need to see a team with multi-skilled capability, but also a harmonious working relationships as well.